If you're carrying credit card debt, a car loan, or a line of credit, and you own a home in Canada, you've probably asked your bank about consolidating that debt. And they probably offered you a personal loan or a debt consolidation plan at maybe 8, 9, or 10%. Let's slow that down for a second. Because here's what a lot of people don't tell you. You may already have access to the cheapest borrowing rate available to you. You just don't know how to use it. I'm Aleem from the Mortgage Free Faster channel, and in this video, I'm going to walk you through why most debt consolidation plans in Canada cost more than they need to, and what a mortgage broker does a little differently. Your credit card is charging you somewhere between 19 and 22%. Your car loan might be 7 or 8%. Your mortgage, somewhere around 5%, maybe less. So here's the key question. Why would you consolidate your debt into a new loan of 8 or 9% when you already have a mortgage sitting at 5%? The answer is most people don't know that they have other options, and the bank isn't going to walk you through it most of the time, not because they're dishonest or anything like that, but because the product that actually helps you most isn't always the product that they lead with. Early planning benefits you, and late decisions, they benefit the system. When you walk into your bank and say, hey, I need to deal with this debt, here's what typically happens. They look at your credit card balances, they look at your income, and they offer you a consolidation loan. Sometimes it's a personal loan, sometimes it's a line of credit or a slightly better rate than your credit card. And on paper, it looks like you're making progress. You went from 22% down to 9%, and you feel like you've made a move. But now you've got a new loan sitting alongside your mortgage, 2 separate debts, 2 separate payments, and you're still paying almost double the interest rate that you'd be paying on your mortgage. Now, the bank isn't lying to you, but they're also not giving you the full picture. Here's the strategy that most homeowners don't know about. If you have equity in your home, meaning your home is worth more than what you owe and your mortgage, you can use that equity to roll your high interest debt directly into your mortgage. Not a separate loan, not a new product, your existing mortgage at your existing rate. Instead of paying 22% on a credit card, you're paying 5% on that same balance. The debt doesn't disappear, but the cost of carrying it drops dramatically. And here's the key difference. You're not taking on new debt. You're moving expensive debt to the cheapest borrowing rate that you already have access to. A mortgage broker can structure this for you, and in many cases without a full refinance, which is the part that surprises most people, because their bank told them they need to break their mortgage and pay a penalty to make this work. Sometimes that's true, but not always. Now let me walk you through how this actually works. Step 1, we look at your home equity. What is your home worth today, and what do you still owe on your mortgage? The difference is your available equity. Step 2, we look at your high interest debt, credit cards, car loans, lines of credits. We get the full picture of what you're carrying and what it's costing you every month. Step 3, we look at your mortgage situation. When is your term end? Is there a penalty to restructure early? Is a full refinance necessary, or can we accomplish this through a mortgage transfer and perhaps adding another component? Step 4, we restructure. Your high interest debt gets rolled into your mortgage. Your new monthly payment replaces your old mortgage payment plus your debt payments. You've got one payment. In most cases, the combined number is lower than what you were paying for before. Here's an example. Let's say that you have $400,000. Your home's worth $400,000. You have a $250,000 mortgage, and there's $30,000 sitting on credit cards at 22%. That $30,000 is costing you roughly $550 a month in interest alone, and your balance is barely moving. Roll that into your mortgage at 5%, and that same $30,000 costs you around $125 a month in interest. Same debt, a fraction of the cost. Now, I know what some of you are thinking, so let me address the most common concerns directly. First one, if I roll this into my mortgage, doesn't that mean I'm paying off my credit card debt over 25 years? This is the most important one to understand, so I want to be clear. The strategy is not to spread your debt out over 25 years and forget about it. The strategy is to consolidate at a lower rate and then continue making the same total payment that you were making before, mortgage plus debt payments combined, at least for a little while. The difference is that now, instead of a huge chunk of the payment going to your interest, more of it is going to principal. You're not extending your debt timeline, you're redirecting the money that was going to the bank in interest and putting it towards actually paying down what you owe. the math changes significantly. The discipline has to come with it for sure, but you were already making those payments. Now they just work harder for you. Now, of course, in a situation where you're not able to make these payments and you're having a cash crunch, then yes, by spreading the debt over time, you're dealing with the most immediate concern, which is cash flow. The second objection is, what if I don't have enough equity? That's a fair concern. And honestly, it's the first thing that we'd look at. If you're under 20% equity, your options do narrow. But here's what I find. A lot of Canadian homeowners are sitting on significantly more equity than they realize, especially if they bought in the last 10 years. Values have definitely moved. It's worth having the conversation before you assume that it doesn't apply to you. The third objection that I see come up most often is, my bank said that I've had to break my mortgage and the penalty, it doesn't make it worth it. Now, sometimes they're right. Mortgage penalties are real and we always factor that in. But here's what a lot of lenders don't know. There's a difference between the way that you structure things. Now, there are certain contracts, mortgages are contracts at the end of the day, and in certain situations, there's some fine print in the contract where you can actually take advantage of some of the stipulations in the contract to your advantage. Now, for example, lenders might be able to add an extra component. We've done this numerous times where you continue to pay the existing mortgage in the same capacity, but then you add another component and you can amalgamate those payments, but you're avoiding any expensive penalties or costs like that. Now, depending on where you are in your mortgage cycle, we may even be able to do this and accomplish everything without having to incur a penalty. It's not a conversation that your current bank is going to start with you, because at the end of the day, what we have to remember is your bank's obligation, when they look at you and your situation, they're trying to make as much money as possible for their institution. Their number one priority is to satisfy their shareholders, which means profit margins. They're always looking to increase profit margins and decrease risk. I want to be upfront about this. The strategy isn't right for everyone. If you're in the last few years of your amortization and you're close to being mortgage free anyway, rolling debt into that stage may not make mathematical sense. If the penalty to break your mortgage is larger than the interest savings that you'd get from consolidating, we'd tell you to wait until renewal and do it then. And if the behavior that created the debt hasn't changed, the consolidation just resets the clock. You clear the credit cards and then they're going to fill up again. The math only works if the habits change alongside with it. Whether or not this makes sense is a personal decision, and we'd have to walk through the details for your specific situation. But if you own a home and you're carrying high interest debt, it is absolutely worth looking into this and finding out. This is the conversation that your bank will rarely ever start with you. And it's not because they can't help, but because the options that help you most often means you're leaving money on the table that could go to them. A mortgage broker's job is to look at your full picture and find the structure that costs you the least. That includes your debt, not just your mortgage. If you want to see whether this strategy applies to your situation, book a consultation and I'll walk you through it. There's no obligation. We just want to provide you with clarity on what your options actually are. And if this cleared something up for you, hit like, subscribe, and share it with someone who's been talking about their debt. They might not know that this exists and there's a possibility. Let's cut through the noise and build a real plan that works.